Hello everyone, my name is 4AS and welcome to my channel. Now, I'm sure you've clicked on this video wondering where the theory of value can go next, especially since we talked last time about how creation has been replaced by extraction in today's economy. You know how growing up you and your mate would copy someone's notes in class? Well, in a world under the thumb of central banks and big business, this sort of analogy isn't far from the truth when it comes to the innovation industry. This is a world where innovation has led to inequity and copying public-funded research to make a quick buck. If you're new here, this is a series of video essays where I cover political, economic, and revolutionary topics which are relevant to our time. I read the books, so you don't have to. In a world where money rules the land, there is one critique that is left unspoken. Integrity leads to innovation. Innovation leads to inequity. Inequity leads to insanity. Join me as we explore the four eyes of capitalism. Consider subscribing for more content in the future. I would also suggest watching my value video because that is the first part of this three-part video essay series, and you'll need it for the necessary context. The link is in the description. Now, let's jump right in. As we were talking about last time, the marginalist way of depicting value made things far more subjective. Eventually, it created a system where value dictated the price and the price dictated the value. Because of this circular reasoning, those who controlled the money held the keys to the economy. To maintain their high profits, the big commercial and investment banks still needed regulators who would keep potential competitors out of the market. Existing big players are therefore helped if banking licenses are restricted. Ironically, the disastrous big bank behavior that triggered the 2008 crash forced regulators, especially in Europe, into further lengthening and complicating an already arduous process for obtaining a new license, frustrating their plans to unleash a hungry horde of challenger banks. The extraordinary power of private sector bank lending to determine the pace of money creation and therefore economic growth. Big companies and big banks were suddenly determining the investments of the market. The old framework of banks where deposits dictated loans was not the model anymore. Banks are not only empowered to create money, as well as channel it from one part of the economy to another, they also do remarkably little to turn household savings into business investment. In fact, in the US case, when the flow of funds is analysed in detail, households invest their savings entirely in the consumption of durable goods, while large businesses finance their investment through their own retained profits. And like that, we live in a world of speculation, even after the GFC in 2008. Although Mariana does make an interesting point. Big business was now funding its investment through its ever-increasing profits, but not in the way you'd expect. That investment they call casino capitalism, the house being the company, of course. I want to make myself clear. This sort of speculative capitalism could not have come about if it wasn't for the rise of finance within the market economy. If price and value are subjective, then it is easy for the main players within the market to dictate what is of value in society. Sure, you could have made the economy about consumables, like Adam Smith would have wanted, but that wouldn't have been so profitable as a diversified portfolio. Why create when you can extract? Or even better, why make when you can convince everyone you create value? by reclassifying them from collectors of rent to creators of financial value added, the newly ignited bundle of finance, insurance, and real estate, FIRE, was transformed into a productive sector at which economists of the 18th, 19th, and even the first half of the 20th century would have marveled. In the US, from 1960 to 2014, finance's share of gross value added more than doubled from 3.7 to 8.4%. Over the same period, manufacturing's share of output fell by more than half, from 25% to 12%. Those of you who have checked out my neoliberalism video would find the source of revelations unsurprising. If your reaction to the 2008 GFC is to bury your head in the sand and put the big banks on life support instead of rethinking the economy, then we're all in trouble. In other words, the big players aren't going to rethink their strategy in this sort of environment. Nobody changes their ways by doubling down. The long history of economic developments, including slowing growth, slowing productive growth, rising inequality, immense technological upheavals, rise in trade, which without adjustments, and then you have this massive financial crisis, which is such a dramatically visible symbol of failure. There are very few things that ordinary people can clearly see and show that the people in charge were clueless. A financial crisis is one of them. It's a dramatic demonstration of cluelessness in the top of the business community, in the financial community, and the government, that they allowed this to happen. And then if you rescue them without punishing the people, well, it's politically pretty hard. But I digress. That little tangent needed to happen for you to understand that if your economy is addicted to speculation and extraction, then this opens the door to new players. In steps the new actors in casino capitalism, the new professional asset management actors of venture capitalists, private equity, and hedge funds. Asset management actors usually make a song and dance about them bringing good returns for their investors and to make companies more efficient and profitable. The VC and PE asset managers are the general partners who take over businesses who have a lot of promise on behalf of the limited partners. That is, the angel or individual investors, pension funds, or other types of management funds that get involved in the venture to get a good return on investment. These firms are called private equity because the companies they acquire are not quoted on the stock exchange, and because they themselves are also privately owned rather than through shares issued in the public stock market. The US PE firms control about $3 trillion of assets, 5% of the asset management market, and own some well-known and large companies. Critics, however, say that private equity firms have a deleterious impact on companies. Their aim is to cut costs in the short term, for example, by firing workers and reducing investment, in order to make a quick profit selling the business at the expense of long-term corporate health. Venture capitalists and private equity put on a facade of, you guessed it, adding value to the companies off the stock market that they acquire. But the reality of the situation is they take advantage of the debt borrowing or leverage that banks give them to extract wealth or dividends from the company they have a fiduciary responsibility towards. Fiduciary responsibility, for those that don't know, involves directors of a company taking actions in the best interest of that company. That becomes a little questionable when you laden the company full of debt and sell it to the highest bidder. However, a good deal of PE firms, investment funds, can be classified as debt. used to buy equity stakes in the anticipation of repaying it with gains in equity value. PE firms are often criticized for placing that debt on the balance sheets of the companies they buy, while continuing to extract dividends from the companies rather than service the debt. PE firms have become particularly adept at borrowing to acquire a firm and then arranging a special dividend, often for a similar sum, which ensures a rapid profit from the deal even if the borrowings transferred to the acquired firm depress its resale price or doom its existence. The PE firm TA Associates demonstrated how far this technique could be stretched when in 2014 it secured a $1.77 billion syndication loan, a type made possible by banks immediately securitizing and reselling them, against drug testing firm Millennium Laboratories, and immediately arranging a $1.29 billion special dividend. The transaction conformed to all rules imposed after 2008 to prevent asset stripping by private acquirers. Some PE firms call it creating value. Critics call it daylight robbery. I'll let you decide what the truth is. Now, I could go into futures, swaps, and derivatives that Mariana talks about in detail. These, of course, are other ways banks extract value in the economy. But what we turn to now is the financialisation of the economy and its inception into innovation. Now, this is a good way to describe my little spiel of innovation leads to inequity within the economy. It's at this time that we should analyse the lasting legacy of Milton Friedman. Along with Friedrich Hayek, you could call Friedman the father of neoliberalism. You can boil it down to one phrase: maximising shareholder value. Right on the dot of 1970, Friedman published an article in the New York Times that would influence the world for the next 40 years. It was called Theory of the Firm, Managerial Behaviour Agency Costs and Ownership Structure. The key argument that managers, the agents, were not being disciplined by competitive financial markets or product markets, since they could misallocate resources or run up unnecessary expenses without incurring losses or endangering their jobs. And so it was hard for investors, the principals, to keep them accountable. The only way to do so was through strengthening the market, which was neutral and objective enough to make sure the company thrived. The result was a body of theory that argued that the only way for companies to be well run was if they maximized their shareholder value. Because, after all, people and companies are utilitarian calculators who live in a perfect free market where we have perfect knowledge, perfect competition, and everything is in equilibrium. What could possibly go wrong? Milton Friedman championed the agency theory, which would eventually lead to the short-sightedness that would plague businesses leading into the late 20th century. In other words, the stock market would eventually promote unproductive investment masquerading as shareholder value. You could say that I'm exaggerating, but think about it. One of the chief components of agency theory was the idea that the principal, or shareholder, was at a disadvantage not knowing the business as well as the agent, the manager. By subscribing to this dilemma, it makes sense that it was both in the interest of the agent and principal to focus their energy on short-term goals, like maximizing the price of the shares within the company. In the US, turnover of domestic shares was around 20% a year in the 1970s, rising steeply to consistently over 100% a year in the 2000s. Turnovers measure how often a share changes hands and is calculated by dividing the number of shares traded in a given period by the number of shares outstanding in the same period. Increasingly, Turnover is a sign that institutional investors' sights were trained on short-term movement of stock prices rather than intrinsic long-term value of the corporation. It should also be said that the short-termist behavior of institutional investors reflects mounting pressure over the last 4 decades from clients who, expecting quick results and with a dislike of surprises, quickly withdraw their funds when disappointed. And all of this isn't even considering the share buyback practices of companies. With principals putting pressure on companies maximizing share price value, no wonder a business would prioritize buying back shares than investing in research and development. Buying back shares increases the EPS, or earnings per share, which in turn makes shareholders happy. Between 2003 and 2012, 449 companies listed in the S&P 500 index deployed 2.4 trillion in buying back their own shares, mostly through open market purchases. That sum constituted 54% of their collective earnings. Add in dividends, which took out a further 37%, and only 9% of profits were available for capital investment. Over the same period, the 10 biggest repurchasers in the US shelled out a staggering $859 billion on share buybacks, equivalent to 68% of their combined net income. Again, we see a vicious cycle with questionable fiduciary responsibility because, as the agency theory states, the agent needs to be similarly incentivized. The CEO package, whilst not fully aligned with shareholders, is a good deal. After all, they receive a cash reward called a golden parachute if they lose their job. The CEO's focus is run by shareholder price value rather than investment in the long-term goals of the company. The average tenure of CEOs has over the past few decades dropped from 10 years to 6. When one considers that CEO pay is heavily weighted towards share price performance, the need for companies to perform in the short term can be viewed not as pressure from an external gatekeeper gone rogue, but as a mutually advantageous setup that has served the interests of an elite few at the expense of the many. Well, you might say, well, that's probably just a few bad apples. What about the innovators in society? Well, you'd be surprised to know that Jeff Bezos, Mark Zuckerberg, and Bill Gates didn't get where they are because they had an idea that went viral. It was a combination of public and private actors that contributed to the creation of the technology we take for granted today. Those who might otherwise be seen as lone entrepreneurs, in fact, benefit from such collectivity. Moreover, they stand on the shoulders of both previous entrepreneurs and taxpayers who, as we will see, often contribute to the underlying infrastructure and technologies on which innovation builds. The iPhone, for instance, depends on publicly funded smartphone technology, while both the Internet and Siri were funded by the Defense Advanced Research Projects Agency, DARPA, in the US Department of Defense, GPS by the US Navy, and touchscreen displays by the CIA. The truth is not some clever tech-savvy university student who happened to get lucky with their crazy idea. The truth is the years of investment and testing by public agencies gets swooped on by VC and PE companies, and you only have to look at one acronym, the IPO. They have taken risks, of course, although mostly with other people's money, which deserve to be rewarded. Yet the returns have come from investing in companies whose value was often created by decades of prior government investment. When the investment bets have paid off in a successful IPO or sale, the venture capitalists have benefited disproportionately from their favorable position as insiders. Then they have gained again from the increasingly favourable tax treatment of their capital gains within a tax system their industry has worked hard to shape. The insiders have incentives to encourage hype about the IPO, setting the price low and limiting the stock's availability to encourage the price to spike. As outsiders clamour to get their hands on the latest hot tech stock, insiders can sell at a large profit. So we have an innovation economy where government and public investments get co-opted by VC firms who sell private companies' inventions to spike stock prices. But the fun doesn't stop there. We haven't even considered the topic of patents. Now, don't get me wrong. The idea of patents isn't a bad one. It's quite frankly the reason why the myth of the university student tinkering away at their gadgets exists in the first place. Patents protect inventors, or those that represent them, in a type of cool-down period where other people can't use their inventions without the inventor's permission. The inventor can enjoy the spoils, or in this case profits, of their invention. But like with most things, theory and practice are not the same thing. First, since the 1980s, the patentability domain has been expanding in the US. The domain has moved upstream. That is, patents are no longer restricted to actual inventions, products, but now include discoveries, the knowledge behind the products. This means that patents are no longer confined to inventions with practical or commercial utility. Now they may also apply to discoveries that help in the exploration of future inventive possibilities, such as diagnostic procedures, databases, analytic methods, or scientific principles with some potential practical application. Patents, in other words, are now gatekeepers to the knowledge base. Instrumental in this shift was the US Bayh-Dole Act of 1980, which made it possible for universities and government research laboratories to hold patents on the results of publicly funded research instead of encouraging better technology transfer. For example, of human stem cell patents held by the University of Wisconsin. The system has delayed technology diffusion. So what ends up happening with patents is what started as innovation and discovering what could be a scientific breakthrough for tomorrow ends up being inequality and value extraction for the wealthy. An early patent gives its owner the chance of setting the dominant standard and blocking improvements others might make. The risk of infringing the patent can also prevent other firms from marketing their products and services. Another related and growing practice is patent trolling. The strategic holding of patents not to develop or commercialize the underlying idea, but deliberately to collect royalties through patent enforcement. A market for patents has emerged in which the value of the production of goods or services the patent makes possible. This is why we've gone from this in innovation to this. And I kid you not, someone in the Apple company in 2022 got paid to advertise that sort of innovation thanks to their patents. But that begs the question, if innovation was so important, why did government agencies roll over so easy to private companies? Well, that is a topic for another day, where we investigate the public sphere in regards to value. If you haven't already, like, share, and subscribe for more content in the future. And remember, folks, to keep thinking and keep learning. Goodbye till next time.